Welcome to The Explainer. If you've ever felt just a little bit overwhelmed by the world of mutual funds, you are definitely in the right place. Today, we're going to build a playbook to help all of us invest smarter and with a whole lot more confidence. So many of our investment journeys start right here, don't they? You hear these incredible success stories online, you get totally fired up with optimism, and you jump into a systematic investment plan or an SIP, thinking, this is it. This is how my money's going to grow. And then, wham, reality hits. The market takes a nosedive, that beautiful green in your portfolio flips to a scary shade of red, and all that initial excitement just vanishes. It gets replaced by this gnawing uncertainty. For so many people, this is the exact moment the whole plan just goes right off the rails. Does that emotional roller coaster ring a bell? Yeah, I thought so. It turns out that leap from total confidence to sheer anxiety is an incredibly common experience for investors. So if you've been there, trust me, you are in very good company. And in this explainer, we're going to dig into exactly why this happens. We're going to uncover the common traps and some of the hidden truths of mutual fund investing. Okay, so let's start with the one thing every single investment has: risk. And as you're about to see, it's about a whole lot more than just the market going up or down on any given day. All right, first up is the big one, the one we all know, market risk. This is the chance that the entire market, stocks, bonds, you name it, goes down because of big things like economic events or interest rate changes. It's kind of like a tide that lowers all the boats, no matter how well-built one single company is. But here's what's really fascinating. Market risk is just the tip of the iceberg. I mean, just look at this list. There's so many other things to think about. You've got manager risk. What if the person actually picking the stocks just makes some bad calls? Totally possible. Or how about inflation risk? That's the silent killer, the one that quietly eats away at your returns over time. It's a huge reminder that risk is coming at you from all angles. So it makes total sense that funds are grouped by these different risk levels. On the safer end, you've got things like money market funds. Right in the middle, you'll find your balanced or index funds. And for the higher risk, higher reward stuff, you're getting into those specialized funds. Honestly, just knowing where a fund sits on this spectrum is the crucial first step to building a portfolio you can actually stick with. Okay, so understanding all those external risks is one thing, but what's so fascinating is that often the biggest threat to our portfolio isn't the market, it's us. Our own behavior can be the real risk that we need to learn how to manage. And here are some of the most classic traps we all fall into. Investing without a goal is like setting sail with no destination in mind. Chasing last year's winner, oh man, that's like trying to drive while only looking in the rearview mirror. And trying to time the market is a game that even the pros almost never win. You can see how every single one of these is driven by emotion, not by a clear strategy.
And this right here brings us to a huge mistake: stopping your regular investments when the market is down. I get it. It feels completely wrong. But continuing your SIP during a downturn means that every rupee you invest actually buys more units of a fund. It's like your favorite store having a massive sale. This is called rupee cost averaging. And that discipline is what really sets you up for long-term success.
All right, let's switch gears and talk about something that sparks, endless debate among investors: fees. Specifically, the expense ratio. It seems so small, but do those little decimal points really matter in the long run? This is a huge, huge debate. On one side, you have people saying every single rupee paid in fees is a rupee that isn't growing in your account. But on the other side, people argue you're paying for expertise. So what's the real story here? And you can really see the two sides of the coin right here. The low fees camp has a strong point. A 2% fee is a 2% hurdle the fund has to clear every single year just to break even with the market. Over decades, that really adds up. But the focus on returns camp rightly says the performance numbers you see are after fees. So if a manager with higher fees still beats the market, well, wasn't it worth it? Here's a really simple way to visualize it. A high expense ratio is like a slow, steady leak in your car's tire. You might not even notice it on a short trip, but over a long journey, say 15 or 20 years of investing, that slow leak can leave you completely flat, costing you a huge portion of your potential wealth. Okay, let's move from fees to something that carries even more weight: the fine print. It turns out the official documents a fund releases aren't just paperwork, they are legally binding promises. This is all about something called prospectus liability. If a fund's official prospectus, its main document, is inaccurate or leaves out a crucial fact, it can lead to massive class action lawsuits. Basically, what the fund puts in writing has to be the whole truth.
And these aren't just simple complaints. They kick off a formal, multi-stage legal battle that is incredibly expensive and risky for the fund company. You can see the stages here, from the initial complaint all the way to discovery. The sheer cost and risk are why most cases get settled, but those settlements can still run into the tens of millions. This is why accurate disclosure isn't just good practice, it's a critical legal shield.
So we've looked at risk, our own behavior, fees, and even the fine print. How do we pull all of this together? Let's build an actionable playbook based on everything we've learned. Here are the 5 core habits of a smarter investor. 1. Diversify, so all your eggs aren't in one basket. 2. Use SIPs to invest on autopilot and smooth out the bumps. 3. Review your portfolio periodically. 4. Match your investments to your timeline. Don't use stocks to save for next year's vacation. And most importantly, stay disciplined, especially when the market gets scary. And beyond those habits, here's your final pre-flight check before you invest. Know your own risk profile. Be honest. Check for consistent performance, not just a recent hot streak. Understand the expense ratio and its long-term drag. Glance at the fine print. And finally, consider getting professional advice instead of just relying on online hype. We've covered a lot, from the psychology of risk to the mechanics of fees and the absolute importance of discipline. So the final question is for you. Now that you have the playbook, take a hard look at your own investments. Is your portfolio truly built to withstand the storms and deliver on your goals for the long run?